Bitcoin recently broke a new all-time high of above $126,000, and this was perhaps one of the most unexpected rallies in recent memory, catching seasoned traders and retail investors completely off guard. But just as the champagne was being popped, a familiar question emerged from the market chaos. Was that the top?
Was it?
Or is this just the beginning of a truly parabolic move?
Just the beginning.
Well, today we're going to cut through the noise. We'll break down exactly what happened, why it was so unexpected, and what the most critical on-chain indicators are telling us about where we go next. And we'll also unpack the institutional price targets for the next 6 months and identify the single biggest risk that could stop this rally. So, to understand where we might be going, we first need to understand how we got here. And the story of this rally begins not with a bang, but with a period of intense boredom. Throughout late September 2025, Bitcoin was stuck in a painfully tight range, consolidating between $108,000 and $118,000. Momentum was flat, and many analysts were predicting either further consolidation or a correction. Then October arrived. On the weekend of the 5th of October, during Asian trading hours, Bitcoin's price suddenly broke through the $125,000 barrier for the first time in history. And the move was so aggressive that it liquidated almost $100 million in short positions in just 1 hour. By Monday, October 6th, the rally hit its peak, with the Coinbase BTC USD pair recording an official all-time high of $126,279. But why was it so unexpected? Well, for most of 2025, every single push to new all-time highs was met with a swift and vicious sell-off. The first run to $109,000 in January reversed in hours. The move above $123,000 in July was met with a 10% decline, and the surge in August presaged a 15% plunge. Traders had been conditioned to expect failure. This time was different. The sheer strength of the breakout caught consensus bearish bets totally unaware, forcing over $923 million in short positions to be liquidated across futures markets. This short squeeze was like pouring gasoline on a fire, adding immense buying pressure and propelling the price to heights few saw coming. So, what lit the match that set the markets on fire? Well, the primary driver can be summarized in 3 letters: ETF. In the first week of October alone, over $5 billion poured into US spot Bitcoin ETFs. BlackRock's iShares Bitcoin Trust, or IBIT, was the undisputed king, absorbing nearly $1 billion in a single day on the 6th of October. This was then amplified by 2 key macro catalysts. First was the US government shutdown. As faith in government operations wavered, investors sought refuge in hard decentralized assets, reinforcing Bitcoin's digital gold narrative. And second, there was growing market expectation that the Federal Reserve would cut interest rates, which generally means that risk assets like Bitcoin are more attractive. So that's how we got here. But the billion-dollar question is, where are we going next? To answer that, we need to look under the hood at the technicals and the all-important on-chain data. Since hitting the peak, Bitcoin has pulled back and is now consolidating in the $121,000 to $124,000 range. And looking at the short-term technicals, there are some signs of caution. The Relative Strength Index, or RSI, pushed into the 72 to 73 range during the surge. Anything above 70 is technically considered overbought, which can be a signal of a potential for a downward correction. Furthermore, the MACD indicator, which measures momentum, has given a bearish signal in the short term, with the MACD line crossing below the signal line. And this suggests that buying pressure is weakening and we could see small retracements. So, case closed. The rally is losing steam, right?
Not so fast.
While the short-term picture looks a bit tired, the on-chain story paints a very different and frankly much more bullish picture. And it all starts with supply, or rather, lack of it. The total balance of Bitcoin on centralized exchanges has fallen to just 2.83 million BTC, the lowest level since June 2019. And this creates an intense supply crunch which could fuel the next leg higher. But are the long-term holders, the so-called diamond hands, getting ready to sell at these new highs? Well, the data says a resounding no. The percentage of Bitcoin held for over a year remains exceptionally high at around 64%.